Daniela Cambone, and welcome back to the Daniela Cambone Show here on ITM Trading. Happy 2024. Very excited to be starting this new year with you. And my first interview of 2024 with someone I have never interviewed before, which is extremely exciting, but I have followed his work for many, many years, and I'm happy to share his wisdom with you all today. Please welcome to the show, Lakshman Achuthan. How did I do on that pronunciation,
Very
Lakshman? He's the
well.
co-founder of the Economic Cycle Research Institute. He has been analyzing business cycles for over 30 years. He's also the author of Beating the Business Cycle. We're going to get his take today. So nice to be with you.
Really nice to be with you. I'm really looking forward to this discussion, and I'm looking forward to the new year. We're gonna have fun.
Yeah, I'm happy to hear that. Let's start it on a positive note here. I mean, I kind of wanted to just do a general overview with you here of what, how you think this year will start. I mean, as we're speaking right now, stocks are feeling some pressure,
hmm
but I want to bring up an article. In my research, I found that you wrote back in 2019, I believe it was for Bloomberg, where you were urging the Fed to cut rates to avoid a recession. And you said the odds of a soft landing go up only if the Fed is preemptive in cutting interest rates. So you were ahead of the Fed. You knew what the Fed had to do back in 2019. My question to you as we start, this year, and there's talk of, going back to a more of a QE environment,
Oh my God.
is was the Fed in time to get what they wanted to get?
The short answer is, I don't want to I don't want to come off as a Fed basher, but I'm always a big believer that we can all improve. And I think there's room for improvement here with the Fed and with some of their policy moves. I know right now the mainstream kind of view is like, wow, look, the Fed has stuck the soft landing, everything's great,
Yeah.
and I'm hopeful that that's true. I would hope that that is true. But our job is to really navigate these cyclical risks that are out there. And so, with our eyes wide open, I have to say, it's not all smooth sailing. There are some risks out here. And with specific to the Fed, the real issue is their main tool is to raise rates and lower rates. And then, as you mentioned, they could also, if under duress, they can go to QE, quantitative easing. Now, um, those kinds of tools impact the economy and inflation with a lag. It's long and variable, and people can debate how long and variable it is, but it's not immediate. The markets tend to kind of try and front run that a little bit and speculate as to what it means when they do something. And so that can have more immediate impacts on some market prices. But the actual real world outside our window, there's long and variable lags. It takes a while for interest rate shifts to seep into all the cracks of the economy. Um, and so now we go to Fed policy. Are they predictive? Are they preemptive? Are they moving in front of stuff? And there I have to say, no, not really. They're not really doing that. They're more reactive. And if you think about, I don't know, all kinds of things in the real world, and if something is kind of cyclical, and you react to it at the wrong time, you can actually amplify the drama. And I'm afraid that does transfer a bit to the Fed and the economy if they're overreacting in retrospect to things, it can amplify drama sometimes in volatility.
So, really well said. So, in terms of amplifying drama, let's talk inflation because going back to your point of things are cyclical. I mean,
Yeah.
they would, I know you've said in past interviews, they're almost acting like it's, mission accomplished. But what I like what you say is, okay, it might be coming down, but the consumer's not feeling it yet. The prices have not come down.
Oh, absolutely. So there's definitely not mission accomplished. There's a few things with inflation, a few critical points, and you hit probably the most important one is for consumers. Um, investors in Wall Street can get very excited about the rate of inflation. So if it was 8 and then it went to 7 and to 6% inflation, they're like, wow, it's improving. But for the man on Main Street or the lady on Main Street going out and buying things, it's still growing and the levels of those prices are really high compared to where they were not too recently ago. And that's a real disconnect between Wall Street and Main Street, which seems to, I don't think that's going to go away. That seems to be the reality of the world, but I think it's a real disconnect between when you speak to somebody or in your own life how you feel about prices, and then the way Wall Street can kind of get themselves all excited about the pace of inflation coming down. Now, the second thing is what a lot of analysts will do, and they'll do this in simple ways, and they'll do it in very, very complex ways in all kinds of models, is they will extrapolate. So if the pace of inflation is coming down, they will say, ah, for all of this year, we're going to have inflation coming down. It's going to go below the target, whatever the target is, and it's all fine, and it's Goldilocks, and we go into that. Now, in studying cycles, and I've done it for several years, more years than I would like to admit, and reading about cycles and the work of my mentor, who was a big cycle researcher, Jeffrey Moore. Um, Number one, inflation itself is cyclical. It has a different cycle. The upswings and downswings are actually different from the upswings and downswings in the economy, in growth. So I would separate inflation and growth. And when we look at times that policymakers have gotten in trouble, they've kind of assumed that some decline in inflation was going to continue way off to the horizon, and uh, taken their foot off the brakes or put their foot on the gas, and things have gotten out of control. And a recent time, relatively recent time, would have been the 70s, when we had a series of inflation cycles for a whole host of different reasons than what we have today.
Mm-hmm.
But the key thing is that there were these big swings, upswings and downswings in inflation, and every time it swung down, there was a lot of pressure on the Fed or whoever, the policymakers, to say, "Oh, mission accomplished," and they put their foot back on the gas, and what we ended up with was higher lows in the inflation cycle. And so you could see they just kept getting higher. It was cycling, but it was cycling higher. And we ended up with average inflation for a better part of a decade of 7% or so. Pretty high.
So that sounds like it could easily happen again.
Uh, Yeah, I think that the way the system is set up right now, a lot of people have the memory of the low inflation following the
Mm-hmm.
financial crisis. And so there's probably a lot of inertia hoping that we're going to get back to that. Now, you have to understand why we had that, and those conditions are not in place today. And then the second thing is that policymakers, for various reasons, I don't think they're nefarious reasons necessarily, but for various reasons, it's easier to bring back the punch bowl, right? And people like you more when you do that, and at least in the short term. And so there's a lot of pressure to don't upset the apple cart. Let's bring rates back down. Let's keep this quote unquote bull market going, and so on and so forth.
Yeah, I mean, I like your point about there being a disconnect, and I think a lot of folks are puzzled because if we look at the tail end of 2023, stocks ended 2023 with a bang.
Hmm.
Gold was high. Look at Bitcoin rallying again. The U.S. dollar is strong. Everything just feel or looks strong, but what's really the reality?
The reality, okay, yeah, that's a really, some I had a teacher Lorene Harris, a great teacher of cycles when I was younger. And one of the most important things that she liked to teach was what's the reality? What's just going on right now outside your window? Because just even knowing where you are in a cycle, let alone predicting it, can be very
Exactly.
just where am I?
Exactly.
And so on that score, just defining where you are in the cycle, we know exactly what to look at. It's output, which would be like GDP or industrial production, things that we're producing. Income, how much are we, the proverbial we, all of us in the country, being paid, businesses, privately, that all that income. Employment, how many people are employed, or what's going on in the jobs market, and sales. How many things are being sold? It could be retail sales to consumers, it could be
Yep.
wholesales to businesses and whatnot, or exporting. Now, taking all of those measures together, I think pretty much everybody would be shocked to know that there's no reacceleration. Q3 was not a blowout quarter last year. Q3 GDP blew out, but everything else was slowing down. And so when we put all those measures into our coincident measures, which define where we are in the cycle, we have the COVID recession, a huge recovery, and then we have a slowdown to right around a 1%, 1.5% growth rate, and then we're just bumping along right there. And there is no reacceleration there. And at the same time, we're having now inflation has been cycling down, but the pace of decline in inflation has been kind of sticky, as people talked about last year, and that is unlikely to change a lot in 2024. It doesn't look like you could just extrapolate that down to the floor, because of some things, for example, like services and wages and things like that.
So what does that mean for the everyday person? What does the outlook look like then?
Well, I think okay, so let's stipulate that the outlook is Goldilocks. Not too hot,
Okay.
not too cold. Everything's perfect. And even in the story of the three bears, that doesn't last forever. That's a moment. You know, there's one moment where everything's fine.
Yeah.
She
Yeah.
finds the right porridge and she's good to go. And then after that, all the bears show up actually at the end. That's how the story ends. But just
Right.
just to point that out. But Goldilocks is kind of a moment in time.
Right.
And when I look at 2024, let's say we're starting from the belief that we're Goldilocks. The economy is good, and inflation is going to behave itself and keep going down. I think the risks are when we look at the indicators on the economy is that there's cyclical factors are pushing to the downside. So the only thing that is keeping us out of a harder landing is a lot of non-cyclical things pushing to the upside. You could think the CHIPS Act or the Inflation Reduction Act or um, the extremely tight labor market post-COVID,
Right.
because for a whole bunch of reasons, there weren't that many people available to work. So all of those things are non-cyclical and they're kind of holding things up, but the cyclical drivers are moving to the downside. When that's happening, any negative shock can have an outsized effect. So I think the risk to growth in 2024 remains to the downside, as far as we can tell. Now, when I switch to inflation, where the expectation is that it's going to continue to behave and go down, and let's not worry about it, mission accomplished, I say, whoa, whoa, whoa. First off, without forecasting anything, inflation's cyclical. It doesn't act like that. It doesn't go down and then just stay there. So that's unlikely to happen. Next, when we look at forward-looking data on inflation, for the United States, it hasn't turned up, but it's not falling very sharply. Okay, it's kind of down and flat. This is our forward-looking leading indicators of inflation. And what's giving me pause, and you can hear it in my voice, is when I look internationally, we do the same thing. And when we look at the future inflation gauges internationally, those are getting a bid. They're starting to move to the upside. And at least in this century, so that's 20, couple decades, a little more than a couple decades, um, international inflation cycles have been reasonably synchronized. So the odds are that if the international inflation cycle starts pushing to the upside, that
Right.
that's a that's an underpinning on the US inflation cycle. So we're watching our US inflation cycle indicators very closely for some signs of a bottoming in inflation pressures in 2024. That could be the other surprise. So there could be a weakness to the downside on growth and strength to the upside in inflation. Those would be my
Okay.
surprises to watch for in 2024.
Nice. I wanted to get your thoughts on housing
Yeah.
because mortgage rates have are double what they were in 2020, and home prices have remained sky high. Mortgage demand has dropped to lows we haven't seen it in 2 decades, with many, thinking that could 2024 be the year that we could see a major housing crash?
Um, Hard to predict a crash, but I don't think there's a lot of reason to think about a sustained move to the upside. I think we're right now in this whole Goldilocks kind of moment. You can get a little bit of activity in housing for a few months or something. It might be like, okay, we're starting to put together a constructive story or something. But with my concerns about growth, coupled with those concerns about inflation not playing to script and kind of like maybe firming later this year, that's not a great situation for housing. That I think would refocus us on the weakness in housing demand. And there's some supply issues depending on where you are, but I wouldn't be super bullish on housing in 2024.
Okay, so that I know I'm going to get this question because I'll run into so many fans of the show who are going to become first time home buyers, and they're just like, just tell me, should I be buying a house this year? And I know there's so many variables and it's
Well,
not a black and white
yeah,
answer.
yeah, that's a tough one.
But what do you tell those folks if they
Well,
come to you and say, what do I do? Should I wait?
well, look, part of it is you're living your life, right? So it's against renting or against other things that you might be happening in your life where you may be at that point where by hook or by crook you need a house and you
Right.
have an opportunity to get a piece of the rock and get a house. I understand that. I would say that even if housing activity firms a little bit in the coming months at least, or prices firm a little bit or something, that I think it's still a buyer's market, and to approach it that way, as it's not really a seller's market. And
Okay.
so
Good.
if somebody was going out and doing things, I would say, yeah, play hardball, and be willing to go through a strategy of trying to have a couple of alternatives to play off against each other.
What's your take on treasuries? I mean, we saw the 10-year treasury yield spook folks back in October.
Yep.
We're inching back towards, 4% as we're speaking today. I mean, what are treasuries telling you here?
Well, um, maybe they're concerned about inflation down there at some point. There's plenty of things to. It depends, right? So let's look at what we have. The Fed says, "Hey, we're willing to agree to 3 cuts." The
Yeah,
market says, "Okay, we heard 6 or 7." Right?
right.
So right there you have a disconnect. Then the treasuries are looking at wait a minute, if there's a cognitive dissonance going on, because if rates are really going to fall the way they're being priced, boy oh boy, growth can't be that good. Growth has to actually stink to get 6 or 7 cuts in 2024. So there's that question, number one. Number two, so there could be some flight, some defensive posturing there. The second thing is switching from cyclical to structural, there's a whole bunch of stuff that is supporting inflation. There's onshoring, there's budget deficits that are pretty big, so a lot of issuance coming down the pike. Um, there may be, with the Fed cutting a weaker dollar relative to other places around the world, at least for a moment, and so then that can get inflationary on the goods side. So we have all kinds of things to be concerned about, even with Japan doing some things. It's so far away, but if they loosen up a tiny bit, it lets global longer term sovereign debt rise a little bit. These are all at play right now.
So are you bullish the US dollar?
Well, not in the very short term. I don't think so. Cyclically, there's some things that are going to undercut it. Um, if you if you do have a negative shock, it's hard to, currencies are tough, okay? Let's just all admit that. They're tough to, that I could do, it's certainly short term. But if we have a shock and we get the wheels coming off in 2024, you can get a flight to quality. So you have to be prepared for that in whatever you're doing. But I think structurally, it's very difficult for the dollar. There's just a lot of inflation that structurally may be getting embedded. AI as an idea to improve productivity, yes, at some point, but not, it's not today and it's not tomorrow. It's going to take a while. And the kinds of the kind of fiscal budget situations are going to demand a lot of borrowing. You already look right now before right now is we're not in recession as far as we could tell, right? However, the federal receipts, tax receipts, are plunging in a way that you only see during recession. So it is typical that during a recession, you go into huge budget deficit spending. It's a little odd that you would go into huge budget deficit spending before a recession, which is what we're doing. So these undermine the currency a bit.
I, I I guess looking, globally, obviously, eh, there's no shortage of tensions
Mhm.
in the world, obviously the Middle East, but there's talk of, how much could the spread, could we potentially even see a World War III, God forbid. But, that said, I mean, as what should an investor do looking at the global picture? I mean, I guess the question is, what are the safe haven plays, if any, here?
It's a tricky one, right? So I'm conceptually, personally, I would have some defensive stuff. So I know that ITM and some people listening are interested in gold. I agree. I think that's got to
Just
be
a little.
that has, that has to be part of the puzzle, and it is for me. Um, At the same time, if we've got some structural inflation, the other kind of question that may be worth asking is where's it going to inflate? What's going to inflate? It's going to be is there a financial asset out there, maybe not the dollar, but something that's going to inflate? And maybe it was the Magnificent Seven last year. I don't know what's it going to be next year. There's the market's going to move around and figure out what it wants it what it is going to be. And so that's an interesting discussion or thought process to go through. And so, in a way, right? I mean, to the audience, you say, okay, if there's a downside risk to growth and an upside risk to inflation next year, what would do well? Um, and start to think through what would do well in that scenario. And one other thing I would add to that puzzle potentially is we've had an incredible downturn in global industrial growth. I mean, it's one for the record books. There's a lot of things for the record books post COVID, but this one, and people don't really look at this. It's kind of esoteric just because we're doing international cycles. We watch this. And so watching international industrial production, that has gone through this incredible weak cycle. And so at some point, that will bottom out, probably when people aren't ready for it. And that could be part of this puzzle as well.
Okay. So when you are doing that thought, when you personally are doing that thought process and are looking at areas that could inflate, gold could be part of that puzzle.
Yeah, and it seems oh, yes. Yes, I agree because number one, look, if things really um surprise people, they're going to have a reflex defensive move, which will be into gold among other things. And we've got a good deal of bond market volatility, right? We're
Hmm.
not in this 2010s environment where policymakers can get away with QE because of low inflation. They could get away with that stuff because largely, I'm oversimplifying this, but China was doing this debt fueled growth, which was exporting disinflation around the world. So even though we had services inflation and other types of in country inflation, all our imported goods stuff was deflating, which gave us low inflation. And so we could do crazy monetary policy moves, not only I'm saying in the West, even Japan, Europe, and us in the United States. And that um, playbook is constricted in an inflationary environment. So I understand why people want to say mission accomplished on inflation. That's the
Yeah.
key reason why they want to do that is because, hey, we can go back to the old playbook of QE. But if inflation is stickier, or if the cyclical lows in inflation are getting higher, then you can't go to that playbook so fast.
That's exactly it. They want to just go back to, let the good times roll again
Yeah.
and bring back that QE.
Hey, as any of the parents listening know, the kids want to do that, right? You want to go back. And
Right.
but if there's inflation, you get constrained.
Yeah.
And that's I think um I'm older than you, but some of the viewers may remember the bond market vigilantes.
Hmm.
They were last kind of really in play in the 90s. And I think it was James Carville who was the strategist for Clinton, Bill Clinton,
Right.
and
Right.
he wrote somewhere, "Hey, if I get reincarnated at some point, I
Well, that's a
would
bond
yeah,
vigilante.
I want to come back as a bond market vigilante because they're more
Yeah.
powerful than the president." And that's a point that maybe will come to the fore again.
Wow. Well, really good thoughts. Fascinating discussion. I thoroughly enjoyed it. I mean, I'll give you the last word. Just like I said, this is the first conversation I'm putting out for 2024. I mean, if you could just speak to all our viewers and investors watching. I mean, what would as they start the year, what would be your words of wisdom here?
Well, I think, and maybe today's a little bit of an indication of that, but we're entering the year priced for perfection. I wish that were going to happen. I suspect it won't. I've identified the risks. I think there's some downside on the growth and some upside on inflation in 2024. Um, and I think that understanding a very important thing when you hear all this information washing over you is understanding the difference between a cyclical move, like we're just having a cyclical decline in inflation, and a structural move. And that I don't think we've had at all. And then to come full circle to the beginning of our conversation, the consumer has to deal with a price level that's a lot higher than it used to be. And
That's
that
right.
hasn't changed, even if we get a tenth of a point off of some CPI print.
Well, Lakshman Achuthan, I'm sure we will
Yeah,
speak again this year.
We should. It's all
Now
Danielle.
that we're finally connected after all these years.
I'm really glad to be connected, and I think this is a we can continue this conversation. It'll be fascinating to see how it goes. And
Yes,
viewers, it's like look, we know we're in a cyclical environment on top of some structural landscapes, and we just have to learn how to ride the waves, and that's what we're trying to do.
excellent. And you could learn more at the Economic Cycle Research Institute. Thank you again. I wish you continued success, and we'll speak soon.
Okay, thank you.
And thank you all for watching. We'll have more incredible content. I mean, we're just really getting started. Happy New Year. Happy 2024. Be sure to stay tuned to the Daniela Cambone Show here on ITM Trading. And you can always sign up to stay on top of all the latest interviews at danielacambone.com. That's it for me. We'll see you soon.